Well, this is what we've been waiting for. The Reserve Bank of India has announced its dividend to the government, and it is not as high as what the street was expecting. Remember, the forecast went all the way from 2.5 to 3.5 lakh crore rupees. What it's coming at is a little over 2.68 lakh crore rupees. Let me go across to Ritu. This is just one of the announcements that's coming from the Reserve Bank. There is also a revised economic capital framework that has been approved by the Central Board of the Reserve Bank. But Ritu, let's start with that. The surplus number, the dividend number, as we were saying, the street was forecasting anywhere between 2.5 to 3.5 lakh crore rupees, and it's come in at over 2.68 lakh crores.
That's right. The street was factoring anywhere between 2.5 to 3 lakh crores of surplus transfer. It has come in at 2.68 lakh crores. You know, I believe the street, at least the Economist, may be slightly surprised because the wider consensus was for the number to be upwards of 3 lakh crores, especially given the large gains that the Reserve Bank of India would have made in FY25 on dollar sales. But that said, this is still far higher than last year's dividend transfer. That was at 2.1 lakh crores, and this is a new record high. It is also higher than the 2.6 lakh crores that the government had budgeted for the collective dividend from public banks, financial institutions and RBI put together. Of course, our own poll had suggested 3 lakh crores. Now, while we get to know the fine print of what really contributed through this large surplus when RBI publishes its annual report in the coming weeks, safe to say the big contributor will be the gains from the sale of dollars that I'll get to in just a bit. But the very important change that RBI has also brought about is the board approving a revised economic capital framework. Now, this essentially mandates that RBI keep anywhere between 6% plus minus 1.5% of its balance sheet as surplus, as contingency buffer, to protect its balance sheet, given the macroeconomic uncertainty in the environment. For FY25, importantly, the RBI has factored in ECF or the contingency risk buffer of 7.5%, which is at the higher end of the new revised ECF range. So even at 7.5%, it is able to get to this 2.68 lakh crore kind of a number. Perhaps, if the contingency buffer was lower, we would have seen a number higher than 3 lakh crores. Keep in mind, the gross dollar sales for FY25 were about close to $400 billion. Given the difference in the prices of purchase and the average price of a sale, RBI would have profited by upwards of 6 rupees for every dollar that it sold. And that itself would have got RBI gains of about 2.5 trillion rupees. And then there would have been the other factors like the interest income it earned on the foreign securities and on rupee securities. So that's where we stand as far as the number is concerned. Not as large as what the street was expecting, still a record high, with the contingency buffer being raised all the way to 7.5% for FY25.
Well, it is 25% higher than the previous year, but not as high as what the street was anticipating. Well, let's bring in reactions now. Madan Sabnavis with us, also Madhavi Arora, Chief Economist at Emkay Global Financial Services, and Radhika Rao, Executive Director and Senior Economist at DBS Bank. Madan, let me come to you first. 2.68 lakh crore rupees, almost 2.69 lakh crore rupees. That's the dividend that's been announced by the Reserve Bank. What was your number that you were working with? As I said, the street had factored in anywhere between 2.5 all the way to 3.5 lakh crores.
In fact, we were at the lower end. We were looking at 2.5 lakh crores. This was based mainly on the budget number and our own estimates about what kind of adjustments could have been done in terms of the buffers. So I think given the uncertain times, it's not really surprising that the board has decided to increase these buffers to 7.5%. And I think that's the major reason why we're seeing this difference between 2.5 and what the market expected, around 3 lakh crores. But I think from the budgetary point of view, I think from 2.1 moving to 2.68, 2.69 is 50,000 crores more, is definitely something which would be beneficial in these uncertain times. I say uncertain times, not just on account of what's happening in the world, but also from the fact that any kind of renegotiation we have on tariffs could mean custom collections could be getting affected. So here we have a buffer out here. And I think and if there's any additional expenditure which has to be incurred by the government, I think that's something also which could be absorbed very well by these things. So I think it's very good from the fiscal point of view. It's not really extravagant to the level of being 3.5 lakh crores, but it's something which adequately takes care of any kind of contingency which the government could be facing during the course of this year.
Well, that certainly is the case. But, you know, you're talking about uncertainty and talking about possible events that could create more uncertainty. And President Trump is at it already, now threatening the EU with more tariffs come the 1st of June. So it is an uncertain environment. And certainly this does provide that much needed fiscal respite and fiscal cushion. Radhika, your first comments, what was the number that you were working with? It's now coming at close to 2.69 lakh crore rupees, a 27% increase over the previous year.
Yeah, hi, Shereen. Certainly, I mean, I think we started off with 2.5 to about 3 trillion, 3 lakh crores. That's the kind of sum we were working with. Certainly a lot of moving factors. And I think one of the biggest ones, you know, while all of us were spending a lot of time thinking about which income, you know, lines would actually add to the dividend buffer, I think the one unknown was what happens to the ECF, what kind of contingency buffer that they would prefer to keep. And I think that's been the biggest source of surprise. Like the other, you know, speakers, commentators mentioned as well. I think for the times we are in, I think it's a very ideal move. Still, there is an increase vis-a-vis last year. Still, we're at a record high. Still, there is about a 25%, 30% increase. And I think in terms of how much it adds to the fiscal you know, revenue, there's still about 30 basis points as compared to what it was budgeted for. So I think it's overall still a positive, but market expectations were quite high. And because of that, I would think for a start, it looks like, you know, it's a bit underwhelming. But when you see the fine print, I think it still adds to positively to the revenue flow as well as potential liquidity boost.
Lakh crores of surplus transfer came from. But on that aspect that you highlighted, and Abhishek, if I could come to you, you know, the street was factoring in upwards of 3 lakh crore, even some as high as 3.5 lakh crores. What will this number mean in terms of, you know, what's been priced into bond yields? Where do you expect the 10-year to settle on the back of this kind of a number?
This number would have been closer to 3.5 trillion if RBI had not increased the contingency reserve buffer by 1% to 7.5%. I think market estimates consensus was a number around 3 trillion. To that extent, it is a modest undershoot. I don't think it should have significant implication from market standpoint. Therefore, in that context, fiscal deficit, any case compared to budgeted 4.4% of GDP, because the historical GDP numbers were revised, was already 4.3% of GDP. Now this additional cushion of maybe around 0.15% of GDP allows that much more wiggle room to government to spend some extra amount on heads, including defense capex, etc., which is being rumored. So it gives more confidence on the fiscal outlook, and it should not have significant implications from market standpoint, given the expectations already baked in.
Yes, already baked in by the market. Abhishek, we'll just come back to you, but let me bring my colleague Sapna into the conversation as well. She's tracking the reactions coming in from the government. Sapna, you know, this does provide that fiscal cushion to the government, as all of our guests were pointing out. Any reactions from North Block so far?
Well, you know, senior government officials, you know, they have been of the view that it's a well thought out, calibrated economic capital framework that has been brought out by the Reserve Bank. And, you know, the dividend number also basically should be read from that standpoint. It's a well-calibrated, balanced policy and dividend to the government. So I think absolutely both GOI and RBI, the management, the RBI management and GOI are very much in sync and on board, you know, on this 2.68 lakh crore. Let me just give some added perspective. I suppose the government estimates were around 215 to 220, somewhere around. It's still around 48 to 50,000 crores higher than that. So it's an excellent number. It also, as the guests have pointed out, leaves some little room for future, you know, fiscal requirements, if any. And this would be what? The additionality would be around, you know, more than 0.1% of the GDP. And I'm talking of the FY26 nominal GDP base that the government has calculated at over 257 lakh crores. it will be higher if you calculate on the FY25 revised estimates of GDP. So, more than a 0.1% buffer that's coming in, ideally it should have helped the government to bring down the fiscal deficit. But we have just heard from, top sources in the morning that the FY25 fiscal deficit is remaining unchanged. 4.8% is what they penciled in as RE, and that's where they stand. So all in all, the reactions here are, sanguine, optimistic, positive, and government appears pretty cool and happy with the number.
Well, yes, Sapna, it certainly is larger than what the government had budgeted for. But Madhavi, let me come to you quickly then. To what extent, as Sapna was saying, do you think the government will adjust its fiscal math based on this kind of a windfall? And how much additional fiscal room can this kind of a surplus create for the government?
Hi, Ritu. So as Sapna was mentioning, the government had taken somewhere close to 2.1 trillion for this year budget from RBI as a surplus. And we were expecting almost 3.2 lakh crore from the Reserve Bank to the government. The delta exactly has come in the form of a higher fiscal a contingency buffer of 7.5 as against our expectation of 6.5% of the balance sheet, which is basically led to this lower dividend. But despite that, there is going to be roughly around 500 billion plus of additional buffer that the government will get from this higher dividend, which is close to around 0.1% of GDP. Now, as of now, we are not looking at government trying to even think of saving this number. Our sense is that the government fiscal math would not change dramatically owing to this. The incremental gain that they're getting from the higher RBI dividend, which will be largely or actually partly offset by a possibly slower tax revenue growth because they have taken a much higher tax buoyancy this year. And we're likely to be seeing a much slower tax buoyancy given the late cycle growth trajectory that we are in. At the same time, we will also be seeing a lower than expected nominal GDP this year. So any additional saving whatsoever, if any, is there because of this would be largely spent than saved. So as of now, we think the gross fiscal deficit GDP ratio would be still at 4.4% for FY26. And any kind of gains that they make out of dividend would be either offset by the slower tax revenues, or if at all they're still left with any, they would be still spending that than saving it.
Yeah, well, that is the fiscal side. But Radhika, let me come to you on the monetary aspect of this. What are the liquidity management implications of this kind of a transfer? We've already seen RBI pumping in upwards of 8.5 lakh crores into the system since December. Now, with this, how much could core liquidity increase and therefore the need for durable injections, liquidity injections in future? To what extent could that slow down?
Certainly, I think even if you had assumed about a 2.3, 2.5 lakh crore kind of addition in terms of the dividend, I think you would have seen the liquidity, surplus liquidity be closer to about 5.5 lakh crores. So I don't think that really changes much. Now with the smaller dividend infusion, we do think that the central bank will remain on course in terms of wanting to keep the surplus in place. Indicatively, they have spoken about 1% of NDTL. At this point, we are about, I would say, roughly 20-25% lower than where they would like it to be. So you could see more action coming away. And of course, then you have the seasonal cycle always picking up, right? You have the currency leakage or the advanced tax outflows. And all of that plays out in the rest of the year. But in terms of the liquidity as well as the monetary policy, there are some expectations that if they do a lot on liquidity, they will not cut more. We do see this as two different approaches. In fact, the governor did mention that just because the stance has become dovish does not mean that that's going to be the stance on liquidity as well. To me, monetary policy and liquidity will be seen as two different, levers. And I think that kind of view is going to hold. So while they do keep liquidity in surplus, I think the reaction function in terms of cutting rates is likely to continue. In fact, the next inflation number could be even below 3%. So that's going to give ample headroom for the central bank to remain on course to cut rates. So again, going back to your liquidity question, I think that this still adds to the core liquidity surplus. This still adds to the surplus that they would prefer to have to make sure that whatever cuts are being taken, it really passes through to the real economy.
Abhishek, to continue where Radhika left off, both as far as liquidity is concerned, as Ritu was pointing out, as well as on the rate cut cycle from here on, given also the fact that we are in a very, very uncertain global mix. I mean, we've seen what's happening as far as the US bond markets, for instance, is concerned. But, you know, back home, what do you expect, what do you anticipate on both liquidity as well as rate cuts?
In liquidity, near term, while technically the durable liquidity goes up, this liquidity will only impact the banking system when it is spent by the government. So the pace of spending matters here in terms of when this liquidity really starts bringing down the money market rates more. It is likely that government could make changes to its T-bill borrowing calendar, like has been their preference. In the past, they have preferred, in the recent past, they have preferred to use any fiscal largesse to cut short-term borrowings and to carry lesser cash rather than cut dated borrowing calendar. It is again likely that Q2 borrowing calendar will be adjusted, and that could help bring down government surplus a little more quickly than would have been the case otherwise. For monetary policy, we are thinking there is scope for 2 more rate cuts. For a terminal policy rate of 5.5%. Inflation this year is going to be very low, perhaps around 3.5% only. In that context, 5.5% may look high, but going down further would increase the risk that next year when food inflation picks up, RBI will need to change course and hike again at some point. It is best if growth concerns are manageable, which is the case if a forecast of 6.5% still holds true for RBI, and that is quite reasonable, even if we are slightly lower. A 5.5% terminal policy rate should be suitable, and next rate cut is likely in the upcoming meeting in August itself.
Mr. Madan Sabdavis, just to pick up from that, in terms of action in the next policy, if this pushes the short-term rates towards SDF 5.75%, and if there is some sort of effective easing, how do you expect that to impact RBI's decision? And also, this surplus, if you see it as a form of monetization of deficit, would it really move the needle on inflation, the 2.69 lakh crores?
This particular transfer of surplus from the RBI to the government, if we are assuming it's going to take care of all the contingencies which are there in the budget itself, to my mind, it's not going to have any impact on liquidity. It's only a case of saying that if this additional 60,000 crores is going to be spent and the budget size is going to increase by this amount, only then will the liquidity impact come in. Otherwise, it will be a status quo if we're going to assume that there's going to be a shortfall on account of customs, maybe on income tax because of slower nominal GDP growth rate. I don't think liquidity is going to get affected, which means that the RBI will have to continue to look at liquidity as a different instrument. You keep looking at OMOs and VRR based on the need base, which is what they have been doing since April and May. Now, in terms of policy, I think the RBI has a very strange situation. One thing is to say that inflation has come down. There is a market expectation that interest rates are going to be lowered. But we should keep in mind the fact that we normally see the vegetable prices going up in October, November. This is because of the changing climate pattern, where the crop tends to get affected and food inflation spikes. So we need to see how the monsoon progresses. We need to see pulses, oil seeds. I think these are the 2 pain points which are normally there. We need to see as to what happens on the tariff front. And more importantly, from a banking perspective, I think we've seen that we have already seen a 50 basis points cut in the repo rate, but the transmission to deposits has been slower because I think there's always this fear for banks that funds will move to the mutual funds. The capital market is still doing well. So the absorptive capacity of the bank is also what they have to keep in mind. So therefore, we feel that the rate cut, while definitely is on, and what Abhishek said, we also believe that 50 basis points cut during the course of the year. June could be a status quo. Observe what happens in June and July before you take a decision in August, and probably accelerate in case everything looks good in the subsequent months.
All right. Radhika, quickly, just to sort of also get back to the contingency buffer being raised all the way to 7.5%. Now, given the current macroeconomic conditions, the RBI, of course, said it was prudent to keep a larger buffer with itself. But would it be safe to say this size of a surplus will not become the new normal? The 2.1 trillion we saw last time and 2.6 trillion that we're seeing now. This is more of a one-off and not really going to be sustainable going ahead.
Yeah, certainly. I think, attention really comes back to the basic math in terms of where the income is getting generated from. I think between years, we will see that kind of, up and down, which is this time around, I think the biggest contributor would have been FX sales, foreign exchange sales, and the change or the different gap in, what the dollar was sold at and what the dollar was bought at. So that would have been, I think, when the breakdown comes and the balance sheet is released, annual report is released, we will see that. So I think that would have been the biggest contributor, apart from some of the other non-interest income headings as well. But yes, I don't think one should take this as a given. The year ahead, as we are seeing on a daily basis, is a very different place. The central banks, policy makers have had to be, I'm sure, keeping their eyes on the target. A lot of things have been changing. So I don't think the government in its own math or the central bank is going to consider this as a given. But that said, again, it's a wide range. It's 4.5 to 7.5. So, there could also be years when the risks kind of settle down, and then we have the contingency, the buffer, the ratio is at a 4.5%. So that could also be the case. So it just brings a whole set of possibilities. But I don't think in the math as well, end of the day, this is also kind of not, I would say, an organic revenue source, right? Revenue source, typically, we should go back to the direct, indirect taxes. That's where the tax buoyancy, that's where the growth matters to revenues. So I would think attention should really be on that. So this is, if anything, a supportive or another additional source of revenue. So I don't think complete dependency will be on this source all the while. So it's going to certainly fluctuate between years. Good years, the buffer could come down. Bad years, the buffer could go up, like we are in. I wouldn't say bad, but a rather challenging backdrop as we are in currently.
Well, it's been a significant buffer over the last few years, Radhika, and of course, it's not something that you can depend on, but it's certainly been a significant cushion that the government has enjoyed over the last few years, and it's only been going up significantly. But let me end by asking each one of you, and Abhishek, I'll start by asking you, since we are talking about risk assessment at this point in time, given both global factors as well as domestic risk factors, what are you going to be watching out for? What will be the triggers that are on your radar as possible risks that the RBI will need to factor in?
Shereen, RBI is in a reasonably good place from the perspective of managing the volatile external sector situation. Current account deficit was below 1% of GDP last fiscal. That is what we estimate, and is likely to remain so this year with commodity prices, including crude, having come down. Yes, capital flows is an issue. POP was in deficit last year, but RBI has done reasonably well in managing the FX market, its FX market interventions. So RBI should be able to frame policy based on domestic growth and inflation considerations. And on that basis, the task is not really that tough right now. Of course, global conditions can worsen more and downside risk to growth could increase. We have to monitor that. But right now, RBI is in a reasonably good place to respond with a clear, stable policy from monetary policy perspective.
Madan?
So in fact, I think given the way in which there is this uncertainty, especially on the global front, I think the major concern for RBI is that if at all we're going to see growth slowing down in the economy, there's definitely going to be some kind of an impact which is going to happen on exports. Exports being largely in the SME sector, I think the possibility of stress building up in the loans given to this particular sector is something which they would be keen to monitor, because I think that seems to be the major risk for the banking system when it comes to this uncertainty which we're seeing across the world.
Radhika?
I think for the central bank, and I think in addition to what the other panelists mentioned as well, I would say the currency has become a lot more, it's allowed to take in the kind of cushion, pressure. So if the dollar, for example, weakens, the rupee strengthens, and which was very different from the past 5-6 years when the currency was kind of moving in the same direction or volatility was very low. So that kind of allows the currency to take in some amount of pressure and adjust So I think that is something that the central bank would keep a very close eye on. And the other one is certainly the growth impulse. I think there has been a large realignment with what the street expected in terms of growth. I think the central bank has also come closer to that. Official forecasts have come closer to that. I think they would watch that very closely because end of the day, not only the external sector, which is trade, but also private sector capex cycles do draw attention from what local demand is doing and what global demand is doing. So there is a fair amount of linkage with how the external environment is. So I think this is where the central bank's attention would be. And having a low inflationary backdrop is certainly a big plus at this point because it gives them a lot more flexibility in terms of what they want to do to support growth.
Oh, that it certainly does. And we have seen that inflation print providing comfort to both the Reserve Bank as well as the government. Madhavi, I'll give you the last word on this.
While I think for me, as of now, the only risk RBI is sort of watching is the fluidity of the global markets, because the way global markets have sort of been very patchy over the past 1.5 to 2 years, I think wherever we've seen RBI really tilting its monetary reaction function has only been because of the global dynamics and less because of the domestic dynamics. So my sense is that currently we are very comfortable in the global dynamics, domestic dynamics. We are seeing pretty comfortable inflation scenario. We are comfortable with regard to current account deficits and the fiscal deficit as well. The only risk as of now is that of growth, for which RBI has already is in an easing mode. Plus, they are also ensuring that liquidity is adequate. So I think to that extent, they're pretty sorted as far as domestic dynamics are concerned. It's the global bit which is going to worry them. And I think they'll be very, very watchful of that, because global dynamics can get really nasty if uncertainty really drags.
Well, since you are talking about global uncertainty, a quick word from each one of you on the latest edition on the tariff wars. President Trump tweeting away. 2 specific tweets coming in this morning, bright and early from President Trump. 1, threatening to impose 50% tariffs on the EU, and 2, saying that he's told Tim Cook in no uncertain terms that if you want to sell iPhones in the US, then they better be made in the US, not in India or anywhere else, or there will be a 25% tariff. Abhishek, let me start by asking you, I mean, this tariff war, one was hoping that there were signs of it abating, but doesn't seem to be the case any longer.
Well, financial markets have been treating, some calm which had come after reversal of the earlier, very high tariffs very positively. But this was always going to be tested because still it is not clear what the exact approach is going to be and what the final target is in terms of administration's requirements. So what we are seeing is volatility is going to stay quite high. These higher tariffs on EU could again mean dollar actually had been bouncing back a little bit after earlier weakening. It is possible it can start to weaken again. In such environments, typically emerging market currencies also tend to be weaker. But given simultaneous speculation that currency levels are also part of negotiations, there is confusion. Broadly, global financial conditions are going to stay quite volatile till there is clarity on US trade policy, and we have to live with that. Our RBI India is in a still better place compared to many other countries, and that is a relief.
Yes, we do find ourselves relatively better positioned, but who knows? But Mother Sabnabis, what is all of this likely to mean now, both in terms of FDI as well as FPI flows, given this very volatile mix?
No, I think definitely FDI across flows to across the emerging markets is something which is going to get affected. And I think India, we were relying a lot on FDI in terms of financing our capital formation. So it was an important source of finance. So what we're seeing here is that FDI definitely is going to slow down across the world, and even India will get affected since America is one of the major suppliers of funds. And the second, I think, is that overall global growth is something which is going to get retarded. So I think these kind of announcements actually sort of makes us lose a bit of confidence in the global growth story. So it's one thing to say that India is isolated because we're a domestic-oriented economy, maybe not directly affected. But I think through the currency, through the investment route, there are going to be implications also for India. But on the whole, global growth slows down, FDI will slow down.
Madhavi?
Yeah, I think I agree with both of them that one, the global risk sentiments are going to be pretty patchy and could be even sour, which also implies that to some extent the emerging market will have to continue offering a much higher risk premium. As of now, there's been massive resilience that emerging market assets, including that of India, have shown, which is also visible by the fact that our emerging market currencies have not only risen since January, but also the emerging market bonds are actually easing, despite the fact that developed market are actually seeing a much higher bond yields over the last 4-5 months, which is led by Germany, and for that matter, US also is now seeing a very sticky term premium and very high yield premium as well. But emerging markets, to that extent, have sort of been much better placed, and have been able to also enjoy some degree of freedom as far as their own policy making is concerned. But if it continues to become a very patchy story in the globe because of US war on trade and US trying to actually disturb the global trade dynamics, there would be definitely some disturbance in terms of supply chain management across the world, and there will be a cost to the world that will be borne by emerging market disproportionately. I hope that is not the case this time around, but we'll have to be pretty watchful for that, and that is exactly what RBI probably would have also thought while they built up a much higher risk buffer this time around when they had extra profit in hand. So whenever they're making profits, they're actually ensuring that the profit is actually kept as a buffer instead of being fully spent. So I think that's pretty wise on their part. But I think while we've seen relative global calm in the recent months or so, we are still in for a pretty volatile world, and the global cycles are going to be very difficult to really predict if that continues.
Yes, we continue to be in choppy waters globally, and that is perhaps what the RBI has factored in as it has enhanced its risk buffers and also delivered a dividend higher by about 27% year on year to the government, providing that much needed fiscal respite and fiscal cushion. Radhika Rao, Madhavi Arora, Madan Sabnavis and Abhishek Upadhyay, always a pleasure. Appreciate you joining us on CNBC TV18 to decode the RBI's math as well as the implications